Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And I'm going to dedicate this video to one of my loyal FastGraphs subscribers, and I'll just call him Pete, by the name of Pete. He's actually a professional, and he inspired me to do this video because he asked me where he could find the PEG ratio on the FastGraphs. And you know, the PEG ratio is a concept, an evaluation metric that I've had many discussions with from subscribers and individual investors and even readers of a lot of my work that I do on my written work. And it really strikes a pet peeve and a chord with me. Let me give you a little background. When I first was starting out with the investment advisory business, where I was launching and actually wrote a brochure for the money management firm, EDMP, Earnings Determined Market Price, that I founded, my wife and partner, just by coincidence, gave me a book. My birthday's in April, and she gave me a book titled One Up on Wall Street by Peter Lynch. Well, in the previous October, I had actually written a brochure, and one of the things that I found amusing, there were many lines in the Peter Lynch's book that were almost directly quoted in my brochure, and I'd never seen Peter Lynch's book before. So it's, you know, a concept that I obviously embrace and adhere to, because much of what Peter Lynch wrote on this subject in his book, especially on the so-called PEG ratio, is something that I've embraced all the time. Now, the PEG ratio was actually, in my view, and I hate to use this language, but it's kind of a bastardization, if you will, of what Peter Lynch actually said in his book, One Up on Wall Street. Now, what I want to point out is that Peter Lynch wrote this book as a growth stock manager. Okay, so what I want to talk to you about here is, first of all, is the PEG ratio a good valuation metric or not? Frankly, I believe the PEG ratio is an excellent valuation metric and ratio when you're looking at very fast-growing companies. You got to remember that Peter Lynch was dealing with, looking for, I should say, he was a growth manager. His Fidelity fund was a growth fund, and it was looking for companies that were growing very fast. He was always, as he put it in his own words, looking for that 5, 10, and even 20 bagger. He's looking for the high growth stocks. And growth is very important because it really affects the time use of money. And we did a video a while back on compounding to point out, if you take a company growing, let's say, at 10% a year, it takes about 7 years, 7.2 years for your money to double. On the other hand, if you find a faster growing stock growing, let's say 20% a year, it only takes 3.6 years. So over any time period of 5, 10, 15, 20 years, you're going to get a lot more earnings power out of a fast growing stock if it can accomplish that growth over an extended period of time than you are over a slow grower. Now, having said that, there's another very famous formula called the Graham-Dodd formula. It was a formula that Ben Graham introduced, and I'll get into this here in a little more detail. But the point is, I believe for the majority of stocks, the PEG ratio concept itself, which is not really what Peter Lynch talked about. And let me explain. In his page 198 of One Up on Wall Street, at least the edition that I have, Peter had a little section titled the price-earnings ratio. And he said, I've gone on about this already, but here's a useful refinement. And this is the crux of everything I'm saying here. The PE ratio of any company that is fairly priced will equal its growth rate. Then he qualified that by saying, I'm talking about growth rate of earnings here. In general, a PE ratio that's half the growth rate is very positive, and one that is twice the growth rate is very negative. Well, I find this formula works, extremely well. Now, that was kind of considered, people then took that instead of P equals growth rate, they've kind of changed that to the PEG ratio, PEG, which is, we always hear about that price earnings growth. Well, it's actually, the father of that concept was Peter Lynch, and it was based on what he wrote in the book One Up on Wall Street. Okay, now at FastGraphs, just to give you some color and some background here, we utilize 3 formulas to value a business. There are 2 primary formulas. I'm calling it Formula 1 and Formula 2. And formula number 1 is basically Ben Graham's famous formula, which I'll cover with you in a moment. Formula number 2 is the P equals growth rate formula, and this is utilized when earnings growth is 15% or better. With the Graham-Dodd formula, and I want to remind you that Ben Graham was working in the industrial age, if you will. His stocks that he was looking at in the 20s and 30s were, U.S. Steel, Alcoa, they were the heavy industrial stocks, and it was the Dow Jones Industrial Average, which is why it was called that. They tend to be very slow growth or low growth stocks. So when Ben applied his formula, value equals earnings per share times 8.5 plus 2 times the growth rate, it was a formula that worked extremely well for low growth stocks. Having said that, the PEG ratio that Peter Lynch really was applying to fast growing stocks, because he was a growth manager, doesn't apply to those at all. And so these are the two primary formulas we utilize in fast graphs. And then there's a third, what we like to call the extrapolated version. And this is a version where we generally, and people ask me about this all the time, draw a valuation reference line on the graph of a straight 15 PE ratio. All right, now what that simply means is this, is that for many stocks, anything growing from, 0 to 5%, we use the Graham-Dodd formula, and you'll tend to get PE ratios of 15 or less. By the way, in his book, his best-selling book, The Intelligent Investor, Ben Graham also said he never pays a PE of 15. In another spot, he said he doesn't believe in paying a PE ratio over 16. But that's, as I've talked about many times, is getting into earnings yield, which I'm going to leave for another time. But the bottom line is, a 15 PE ratio equals a 6.5 to 7% earnings yield, and that's somewhere in the midpoint of what the average return stocks have generated historically. So Ben was dealing with these industrial low growth stocks, and so his formula that he used was made famous. We apply to any company that's growing at 5% or less on fast graphs. In contrast, if we're looking at high growth stocks, then we utilize the faster growing P equals growth rate formula. And let me go through some fast graph examples and try to elaborate on this for you. Let's start here with a fast growing stock like Facebook. And actually, I probably should be wise to take the price off because I want you to really see the impact of this. If you look at Facebook and look at its earnings growth, earnings went from 53 cents a share in 2012. Look at here, by 2014, earnings have grown to $1.77, and by 2015, they were $2.28. That's a 33% growth rate that Facebook accomplished. That includes the forecasting data on this graph. So when we're looking at very high growth, above 15%, we automatically apply Peter Lynch's actual formula, the one that he actually presented in One Up on Wall Street book, PE ratio equal to growth rate. We call it PE equals G. And I want you to notice the growth rate is 33.2%. And the PE ratio that we apply as a valuation reference is 33. So what we're saying is, for a company like Facebook growing this fast, this is the fair value calculation. It's much higher than the 15 PE ratio that I talk about. Now, when I put stock price on the graph here, I want you to notice that Facebook stock price has correlated. It has tracked that earnings growth rate very consistently historically. So it really does make sense. Now, we apply the normal PE, it's a little higher because there were some times when the growth rate was higher. So these valuation reference lines that we draw in a fast graph, like I said in the previous video, we're not dictating fair value, we're revealing it. Now, based on this growth rate, this historical 33% growth rate, Facebook looks undervalued. But you are learning from the past. Now, I can do a couple of things here I want to do with you that kind of give you some insights. I can scroll out the estimate data, okay, which, means now I'm only looking at historical growth. Now I want you to know that the growth rate jumps up to 39.38. I want you to notice that the PE ratio of the orange line is 39.4, 39.38 rounded. So, we're applying the growth rate, but it's a valuation reference. You evaluate that by looking at the real historical evidence of what valuation the stock traded at relative to historical norms. Now, when you're looking forward, however, and this is critically important, you've got to look at what forward estimates are. Now, Facebook is expected to only grow at 16.26% going forward, which is still very fast. So now we're still utilizing the P equals G growth rate formula, and we're drawing the fair value reference now at that forecast growth at the 16.26% number, which equals the growth rate. Now, that would be very attractive. Now, we can also then go into the longer-term trend line growth rate on Facebook, and this is a different number. It's a different forecast where you have the analysts, and there are 3 analysts in this particular universe that are forecasting the long-term trend line is for Facebook will be 23.41. So now we're utilizing a 23.41 PE ratio as our valuation reference as a long-term. Now, I can also use fast graphs. I can go into the custom portfolio and I can combine the near-term estimates with the long-term growth rate and get now a picture of valuation going out there. Now, is it correct? Probably not. Is it reasonable? Hopefully. The key is I'm looking at near-term forecasts here where we don't expect growth, to average over 18% for the next couple of years. So the analysts think that there is a plateau that Facebook has hit, but they do expect it to be longer. Now, there are other ways we can value a fast-growing stock. I can go into the historical growth rate calculator here, emphasizing that with fast graphs, these are calculators. These are tools. I call this a tool to think with. Now here, Ben Graham also said, interestingly enough, that as a valuation reference, you can use a company's in lieu of forecast, you can utilize a company's historical growth rate. And he said the average of the last 5 years. So the average growth of Facebook over the last 5 years has been 34.65%. But this drop down gives me the growth rates of Facebook going all the way back throughout its entire history as a public company. And what I want you to notice is those growth rates vary. They were 40 and 50%, back in the 9, 10th, and 11 years ago. 8 years ago, they were still in the 40s. Then 6 years, it dropped into the 30s. Then it got into the 20s, into the teens. It was only 15% growth for the last 2 years. And now the last year, it's expected to grow at about 57%. You can see that here on the forecast. All right, so, the reality is I'm using the historical 5-year growth rate here of 34.65, and I'm drawing a valuation reference here. The point is, we're revealing valuation based on historical norms, based on future expectations, and trying to come up with a rational decision to decide whether or not we think a stock like Facebook is attractive or not. But because the growth is above 15%, we're using the PE equals growth rate formula in all of these calculations. Now let me move on and let me move into a different company. Let me go to the complete opposite. Let me go to the Ben Graham formula. Okay, here we're looking at Campbell Soup. And I want you to notice now the formula that we're using is labeled GDF. That stands for Graham-Dodd formula. And that's the formula I showed you in the slideshow a little earlier. And with that case, when you're evaluating the EPS times 8.5, which is the interest rate, plus 2 times the growth rate times 4.4, blah, 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 the Graham-Dodd formula actually gave us a fair value of 14.52. Now, that's not 15%, but it's obviously pretty close. Rounded, it would be. The normal PE has been about 16.8, which is the blue line. So here, when we're applying the Graham-Dodd formula, we're going to be using quite often a 15-ish. I'm going to emphasize a 15-ish PE ratio. But the key is, once you draw that valuation reference line on the ground, once FastGraphs does it with the appropriate formula, it's your job now as the analyst to evaluate that. And with Campbell Soup, as an example, you would say, the 15 PE has been a very good valuation reference. It's been almost an optimum valuation reference, if you will, a lot of the times, coming out of the recessions especially. But then during the good times, we've had much higher valuations. But the key is, and people say this all the time, that's another one of my pet peeves, value investors don't care about growth. That's hogwash. We do. This is not going to be a high rate of return investment, by the way. If I go into the forecasting calculator here, analysts are expecting 3.45% growth. There are 17 analysts forecasting these low growth rates. It's 3% for this year, which, by the way, their fiscal year ends in July. It'll be only 1% expected the following year, followed by 6%, and it averages out about 3.5%. So if I run these calculations using a 15 PE ratio with that 3.45% growth rate, it would be a little higher than what I showed you historically. I would get very low rates of return investing in Campbell Soup, but the stock is at fair value. Okay, but the fair value simply means that it allows you to participate fully in the growth potential of the business. It does not mean that it's going to be a great and very highly profitable business that's going to make you a lot of money. It just simply means that you're paying a prudent valuation that allows you, and this is so important, I'm going to repeat it, allows you to participate to a full measure in the company's business. But now let's apply the PEG ratio, if you will, or the PE ratio equal to earnings growth rate to this. So I've gone into our custom settings here, and I've put in a 3% growth rate, which is the 3.01. That we saw historically. So I've used historical growth here, and I've drawn this, magenta line, if you will, and this would be a PEG ratio of 1. Remember, Peter Lynch said value is when the PE ratio is equal to the earnings growth rate. A PEG ratio of more than 2 would be very high, a PEG ratio of half the growth. But here, the point I want to get here, this is real world evidence that I want you to basically notice that you're looking at here. If I put a PEG ratio of 3 or a growth rate ratio of 3, it's completely irrelevant to this low growth company. The stock price never even smells that level of valuation. Now, if I calculate the PEG ratio, and let's do it very quickly, I would take the current PE ratio of 15.4 and I would divide it by the earnings growth rate of 3.01. So I divide 15.44 by the earnings growth rate of 3. I get about 4.96. We'll call it a PEG ratio of 5. Okay, which is obviously more than twice as high as the growth rate, which Peter said was very bad. But the real point is, it's a PEG rate, but there's no way for this to have an attractive PEG ratio with earnings growth this low. The PEG ratio, drawn down here on the graph, putting it into perspective, doesn't have any relationship to the stock valuation at all. It simply doesn't make sense. Now, for the third formula that I mentioned earlier, we do what we call the Graham-Dodd extrapolated P equals growth formula. And what it really boils down to, it goes to what Ben Graham said in The Intelligent Investor, and that is he just doesn't believe in paying a PE ratio above 15 or 16. So when we're seeing growth between 5% and up to 15%, here we've got 8.35% on Johnson & Johnson, we simply draw a 15 PE ratio, and lo and behold, that line fits the graph very nicely. This is a AAA rated, low debt, high quality Johnson & Johnson, one of the only two of, companies with a AAA credit rating. The market does put a valuation premium, but now this is another pet peeve. The people will say, well, because of the quality of this company, doesn't it deserve a premium valuation? Well, I don't really care what the company deserves. I care about you, the individual investor. I care what you deserve. I don't believe you deserve to generate a low rate of return by paying a high valuation for a stock, because when this reverts to the inevitable mean, your rate of return is going to be lower. What I'd rather see you doing is buying the stock when it's trading at a discount with the margin of safety I talked about recently. Here now you can blow your returns up to double-digit rates. Now, Johnson & Johnson will still make you money paying these higher valuations for it. Don't misconstrue what I'm saying here. I just don't think you're making as much as you deserve to make had you bought it at a better valuation. But either the 15 or the 18 PE ratio here at least is sane. It's not crazy like we've seen with some of the tech stocks. So let's review things. Let's look at a company like LKQ, which is auto parts. All right, an auto part distributor. Here we have a company growing at 19.6%. The PEG ratio of 1 is what's drawn on the graph. We're drawing the line at a PE of 19.5. That represents a PEG ratio of 1, which is what Peter Lynch said was an attractive, ratio. In other words, when the PE is equal to the company's earnings growth rate, that's fair value. And you can see that LKQ tracks that very nicely. But that's historical based on a 19.5% growth rate. Watch what happens. I've got 3 years of forecast here, so I'm going to drop this to 13 years, which gives me 10 years of history and 3 forecasting. Now the growth rate's down to 14.3, and I'm using that extrapolated formula, which is drawing a 15 PE, and this now starts to become more relevant going forward. When I go to forecasting, analysts are expecting growth of only 8.6. Now, if I go into an external link like Yahoo Estimates here and look at LKQ and scroll down here, for the next 5 years, analysts reporting to Reuters expect 33% growth. Okay, so I could go into my custom portfolio here and I can add 33% growth. In other words, I can hit 33 and then draw the graph, and now I'm using a long-term growth rate of 33%, and the company would be undervalued. The point I want to make here is we're dealing with estimates. We're dealing with forecasts, and forecasts typically are wrong. But what I want you as subscribers of Fast Graphs especially, I want you to use this as a tool to think with. Run it through its paces. You could also go into the forecasting calculator, by the way, and use the historical growth rate instead of analyst estimates as a proxy for valuation. And you've got this drop-down table which reviews all of the company's historical growth rates, and it's doing it without any estimate data contaminating it. And you can clearly see the growth has been slowing down here in more recent years compared to what it was in past years. And that's, not uncommon to see the growth rate slow down over time. You can see it slowing down here on the regular historical graph. So if you are a subscriber to FastGraph, use the tool correctly. The bottom line is, when you're looking at high growth, you also want to do things like, here we're giving no meaningful figure. So what I've got here is I've got a really large number. So I'm using my tool now. I'm going to get rid of that number. And now I've got a growth rate of 21, so I apply a 21 PE. That was a great PE. Now, as I've talked about in the past, we've got this irrational, exuberant period where a lot of stocks, this is life sciences and services, has gotten, a lot of this tech, we'll call it, has gotten hot. And the bottom line is, expected to grow at 15%, which is an awesome growth rate, but it doesn't justify, in my mind, a PE of almost 41. The potential loss over the next 2 or 3 years is enormous on this, and if nothing else, it would be dead money. Now, the PEG ratio, though, does apply very nicely here because you've actually got a fast-growing company. And if I go back to a company like Johnson & Johnson or 3M, where the growth rate is lower, then I'm only going to use, the Graham-Dodd extrapolated P equals growth rate formula. If I put something like a Southern company up here, a low growth utility stock, for example, like we showed with Campbell Soup earlier, you're going to get a company that has growth of less than 5%. And so what's going to happen is you're going to see that the tool automatically applies the GD formula. So what I'm really saying here, and I'll kind of summarize, here we've got growth rate of 2.6%. And we're using the Graham-Dodd formula. We're putting a PE of about 14 to 16, and you could call it 15, as kind of a midpoint there. And again, it allows you to evaluate that. Historically, those have been good valuation references for low growth, utility company, Southern company. Again, this is a tool to think with. So is the PEG ratio a useful metric? Absolutely. If you're dealing with, very fast-growing stocks like Facebook, then yes, the P equals growth rate formula is extremely good. So if you're a growth stock investor, the PEG ratio is an awesome tool. If you're investing for dividend income and buying the average, growth stock like the Johnson & Johnsons, the Coca-Colas, etc., the 3Ms as I showed you, then you want to kind of use that extrapolation. You want to be real careful because the company doesn't grow fast enough to justify high valuations. I hope this gave you some additional insights into the PEG ratio. It's a pet peeve of mine because I very much believe in the PEG ratio if I'm analyzing and applying it to the right kind of stock. But if I'm applying it to normal growth or low growth stocks, I don't see where it provides any real utility, like I showed you with the example of Campbell Soup here, where you've got this, using the P equals growth rate formula. It doesn't even make any sense. There's no relationship to valuation at all. Hope you found this useful. If you like this video, don't forget to hit the like button. Give me a share if you also feel that others might benefit from this. And of course, if you're not a subscriber, please subscribe so you can get access to more videos like this. This has been Chuck Harvell saying thanks for watching.